Okay, hello. This is Greg Womack, and here we are for the market summary and current outlook, and for the Happy New Year, this January the 12th, 2023. And we've got a number of attendees in, and we thank you for attending our webinar. And just a quick show of hands, perhaps, make sure that you guys can hear me okay on my speaker or on my microphone. Make sure everything's working. Good. Thank you very much for confirming that we can begin here. Okay. We'll probably have a few more that'll join us here in just a minute, but wanted to start out this new year with just talking about, what a year 2022 was. It's almost hard to say 2022, 2023, but yeah, it was an interesting year. We're going to go through some numbers and then talk about, kind of the current outlook and strategy, what we're doing here at WIA. So just to kind of kick it off here, we'll get going. Pardon me just a second. Okay, now we can go. All right, and if you guys have any questions as we move along, I'm going to do a couple of polls in here. So hopefully you can participate in those polls. And if you've got any questions, would love to have you, type those in or raise your hand, and I can allow you to talk, and we can visit about some of the questions you might have. So thanks again for attending. Let's get started. Okay, let's talk about, you guys know about who we are. I think everybody on is a client, so we're not going to spend a lot of time on this chart. We'll get right into the meat of the performance update. So as you can see, 2022, despite a fourth quarter rally, the U.S. markets were down across the board for the year. The Dow finished down about 8.8, which is not on this chart here, but then the S&P for the year was down 19.7, NASDAQ 33.5, S&P small cap 17.5, and then international stocks in general, based on the EFA index, is down 16.2%. And so the international market struggled as well. So it was a very difficult year for the markets. We started out in a bear market back in March of 2022 on the S&P, and it still remains there today. Materials and commodities were kind of mixed. Crude oil finished up strong. Silver was up about 3%. Gold finished basically flat, down just 0.1%. Copper was down about 14.6%. Material stocks down in general about 13.9%. Bonds were in negative territory. So, typically what they call the 60-40 mix, which, 60% stocks, 40% bonds for a more conservative portfolio, that actually turned out worse if you had invested in a lot in bonds in 2022. They were down even worse than stocks were. And that's because rising rates were going up. And so fixed income securities were down across the board. The Federal Reserve raised the federal funds rate 7 times in 2022, more anticipated on the way. Current Fed rate now sets at a range of 4.25% to 4.5%. The only thing positive that's this really done is it's helped to where we have better money market rates. We recently moved a pretty good chunk of our cash positions into a Schwab money market that's paying right around 4.25%. So that's the positive about higher rates. But if you were in bonds, you definitely took a hit. And so in 2022, investors, faced one of probably the most difficult years in the markets in decades, as the Federal Reserve is trying to combat inflation, worse since the 1970s. So it sent stocks and bonds reeling. So Jim Reed, he's head of the thematic research at Deutsche Bank, shows in the chart here that 2022 experienced the worst combined total return for both stocks and bonds, at least back to 1872, as far back as comparable records reach. So as both stocks and bonds fell, the much heralded portfolio of a 60-40 equity bond ratio dropped almost 20%, the worst return for this type of a portfolio since 1930, it appears. So, like I said, we fared the markets way much better than the general market. A lot of that due to our indicators that back in March, when we got that bear ratio, we went ahead and reduced a lot of exposure to equities and kept everything in cash. And that helped out a lot, where our portfolios were down 50% less volatile than the general market. Gold, as I mentioned earlier, didn't do as good as we'd like in 2022. It's kind of flat, but it's now reversing. We're going to get into that here in just a minute. But just talking about sentiment, being a part of a successful investor is recognizing the important inflection points in sentiment. And right now, we're probably in, we're not at, it's hard to say where we're at. This is kind of a different market right now. So what we're seeing is the market here, when you go through a bear market like so, whoops, let me get back there. When you go through a bear market, like we've seen here recently, we've kind of in this phase here. Pessimism is what we're seeing mainly. It doesn't mean we're not coming out of it in this range either. Okay.
All right. Okay.
Thanks.
Hey Jeff, you might want to mute your microphone there, bud. Jeff's joining us. So, but yeah. So long story short, let me just kind of erase these, but so it's hard to say where we're at because we really haven't had a major capitulation yet. And it doesn't mean we have to have a major capitulation for us not to get some type of reversal in this market. And so we're kind of in that stage of building that bottom, if you will. So it all depends upon sentiment. And I did read one sentiment today that I didn't have time to put in that showed that most investors are very pessimistic about the market, and usually when people are pessimistic, they throw in the towel, so to speak. That's typically a good sign of a bottom. So it's hard to say where we are exactly because my crystal ball is broken. It should be getting it back sometime soon, but there could be a chance that we do see some recovery in this period. Here for a while doesn't mean we may not see another downturn at some point, but that's all part of the emotions and the sentiment in the markets. So all I'm trying to say here is we've been through the worst part, hopefully, and at some point we do put in that bottom, and then we start to see more hope and relief and optimism in the markets. So would like to do just kind of a quick poll. Launch this poll right here, and the poll basically says, where do you think we're going to end up with the markets by the end of the first quarter? So the first quarter of this year, no clue, down for the quarter or up for the quarter. All right, everybody had a chance to participate in that. Okay, let's see if we can publish the poll here. It looks like it'll publish. Yeah. Okay. So 25% of you say you're up for the quarter, 25% down for the quarter, and 50% no clue. So I'm kind of in the same camp. I think we have the opportunity to move higher, possibly. We're starting to see some of the big tech companies, especially putting in a bottom, starting to move higher recently. So this first few couple of weeks of the market for this new year has been better so far. Okay. Let's go on to the next one here. So just a few talking points, things that could cause more fallout on stocks. I think we all know the Fed's going to probably continue raising rates unless we get some kind of really negative, where the economy is slowing down substantially. But we probably can see the Fed's continue to raise rates. That's going to put pressure on companies to borrow money and dig more into their earnings. Continued higher inflation is also a concern. So if that continues, the Fed will probably continue to raise rates at even what they have been doing possibly. Or if we get into a full a recession that's worse than what the market is pricing in right now. So any kind of negative news in the market could cause more fallout in the stocks. Also, any geopolitical or political fallout, and of course, always a possibility is any kind of black swan event that would cause the markets to be blindsided. So when you look at inflation, let's talk about inflation. The Fed's, still their lowest low ball inflation measure hits a 30-year high, as you can see here back in this past year. It since has come off that high inflation number. So the inflation rate did slow. Recently showed a slower than expected rate of inflation of 7.1. That's down from a peak of 9.1 in July. Now, this bottom one is showing the consumer price index right here. This top one here is showing how they used to calculate it based on the numbers back in 1980. In other words, the formula they used. So some feel that inflation is much higher than what they're showing us because if they manipulate the numbers. Instead of looking at prices of beef and food, for example, they replace it with chicken or some kind of lower form of food, replacing certain items in the CPI index to make it look not as bad. So probably the real rate inflation is in that 10 to 15, possibly higher rate of inflation. So this shows you here. This shows the stock market at 122-year plus view, and it clearly shows the market benefits from the multi-year periods of dramatically rising prices called these secular bull markets. And then it's followed by multi-periods also where there's, where the market may go nowhere, or it's called, the bear markets. Down below here is the Case-Shiller price index. As you can see through the bear markets, when we go through periods where there's not much rate of return during these periods, then the typical PE ratio goes down. As you can see here, the price to earnings ratio. And typically it's got to get, it'll peak out, usually above 30 or close to it. And then it will need to come down to that 10 range or below for us to, have a new foundation for a new long-term bull market. So there could be more downside, as you can see on the PE ratio here. History would say that. So at some point, price to earnings, either earnings have got to go up substantially or the prices have to come down at some point. So what we want to focus on is fact-based investing, because there are opportunities even during bear markets, and we're seeing some of that right now. We're in a lot of positions, not too many, but we're in a lot, some positions that are putting in a bottom and they're starting to really move. They're paying really nice dividends, particularly in the tech side. And of course, the energy is a strong sector as well. So what we want to do is we want to focus on that supply and demand. Basically it's the more supply you have of the stock in the market, the lower the price. The higher the demand for stocks, then naturally the higher the prices will trend upward. So fact-based investing basically makes no market, predictions, does not require the markets or investors be rational or efficient, and does not remain fully invested regardless of the market circumstances. So when we implement a fact-based strategy, We want to look at a number of things. Naturally, the big picture of the market, what is it doing? What is, instead of what might be or what ought to be. As you can see from our U.S. equities bull bear indicator, we went into a bear market back here in March of 2022. And when that goes through this red hash mark, that tells us, and this is a grayed out area down below here, that this market, started the downturn. This is based on January the 6th indicator here. So we would need to get back up to a 55 here before the market would have the strength back. That's that demand back in the market to pick up all the slack. And right now we're sitting at about a 41.5 on the bull bear indicator. Another one we look at is bonds. Bonds were back in October of 21. We started seeing the bear market in bonds, and you can see it right there. We had a short one back in 2021. It went positive in July of 2016. Then again, October went negative. Here's February. But long story short, bonds have been in a decline, and that's why we've seen such a negative return on bonds lately. Yeah, at some point, we could see, bond prices do better if rates keep going higher. At some point, they quit raising rate, or rates start to mellow out and actually ease up. Bonds could be actually a decent investment at that time. But for right now, they're still in a downward trend. As I mentioned earlier, international stocks did not do well. You can see they've been in a bear market since February, which is about a month before the U.S. markets. And so we're seeing some improvement in the international markets, even a little bit more so recently. You see the little move we've got here, and we've seen that improve compared to the U.S. stock market, actually. And then real estate, kind of the same thing, May of last year. Real estate prices, this is really more of the REIT index, not housing necessarily, even though housing is still strong. We're seeing even housing ease up just a little bit on the mortgages and such because of higher interest rates. Energy has been very strong. October 28, 2022, I guess, is the last time it went positive. So we do have some exposure to some energy positions in the models and in our option strategies that we're utilizing. Then, of course, I want to talk about gold. Gold is still, I encourage people, we own at least 10 to 20% in the precious metals to protect against inflation and market uncertainty. When you look at the gold strength indicator, 2022 was a little bit down, then ended up flat for the year for gold. So it went negative back in September of 2022. So toward the end of last year, it started kind of going downward, put in a bottom in November. So I'm anticipating that we'll see gold turn higher, especially as we see the gold prices continue to rebound. And so they have rebounded from their lows. You look back in November lows here, gold prices were, down here in this range. Now they've had a nice move up. It was pretty much flat for last year, but now has put in a bottom. It is up 3.8% as of today, and is up over 12% since these lows in November. And this is measured by the Spider Gold Trust shares. And historically, we want to take a look at, the dollar versus the gold, and, it's a good diversifier. And, even though it's not going to go up every year, possibly over a long period of time, it can help provide good diversification against currencies that are maybe, going down, and particularly our purchasing power. So we owned both the physical and the physical silver and the physical gold, and some mining stocks as well to help in this regard. So what are some of the top sectors to invest in today, perhaps the near term? Oil and gas stocks continue to remain, stronger. A lot of good income and dividends are paying. We anticipate that to continue for some time. Metals, as I just mentioned, both industrial and precious, we're seeing some turnaround in the copper prices, and so that's helping copper mining stocks, etc. Commodity prices are still pretty firm, whether it's agriculture, energy, basic materials, defense stocks, U.S. defense companies. So we have what we call one of the defense ETFs in our portfolio. Utilities might be there for a while. They pay good dividends, but if rates continue to go higher, that could hurt utilities. So that may be a little bit short-lived. And then having some cash and money on hand. As I said, we've got a little bit of cash, and we've moved a good chunk of that cash into the money market. That's making about 4.25%, a lot better as well. And then start dipping our toe into some tech stocks, because some of these companies like Intel and IBM and others that are and bigger companies too that are putting in bottoms and paying really good dividends. So those are some things to look at and to consider. All right, here's another poll. Let's launch this dude. And let's see here. Launch a poll here. What are we going to do here? Stop sharing. Okay, here we go. Poll number 2. How do you think the markets will end up for the year? Let's say the S&P, up strong, up slightly, down to flat, or down big. Give you a second to put in your answers there, and let's kind of see what everybody's thinking. We got a few more that need to vote and take their poll. Okay. So it's a kind of a mix, up slightly and down to flat. So not too bullish there, but not too bearish as well. And that's, I think that's a good point. I'm going to get B. I'm going to let you allow you to talk. B, can you hear us? Your microphone's muted if you want to say something. Okay, well, we'll get back to you here in a minute. All right, so let me see here. Okay, there's the results of the poll number 2. So most, looks like, this is kind of not too many or too bearish or too bullish. And we've seen such a long, what I'm going to call bear market, really, that it's hard to say, what could happen. Let me go back to this. I want to go back to this particular chart here, and go through one other thing. If I can find it. Yeah, so it's hard to say what could happen, but we've been in a bear market now. I was trying to see my notes here. So I think the longest bear market was about 600 days. And the average bear market is as little under a year, about a year. Okay. So long story short, we've got, we've been in a bear market for pretty much over a year now. Let me get to that chart again. Coming up on a year is what we've been at. So technically, we still could see the market, go down a little bit more, but hopefully we've seen a pretty good chunk, because a lot of companies in the tech field, are down 50% or more, and they still have good earnings, for down the road forecasted as, eventually, even though we may go through recession, which the market's already, I think, priced that in. But what we have to look at is that as the news comes out about the economy, is it going to be worse or better than expected? and that will help. I think will drive the markets perhaps even more than the Fed raising rates at this point. So as long as the market can continue to have a decent foundation, then and some earnings growth, even in the midst of some rising rates, that speaks pretty well of the market, so of the economy. So I'm going to open it up for questions right now. It looks like we got a couple here. So Bernard has a question: why do you think agricultural commodities is the way to go with the storms and problems on the West Coast, crop damage, fruit damage, supply chain problems, and ships coming into ports? So basically, we're beyond on that aspect of it. You know, it's all about supply and demand. So if you have, you know, a pipeline in Norway that goes bust and it shuts supplies down to customers, you're going to see energy prices spike. And the same thing with agriculture commodities. You know, we could see a shortage of crops, especially in the supply chain areas, and ships coming into the ports, etc. I know that a lot of farmers right now and chicken farmers and beef farmers are you know, they're running short of feed, and so it's hard for them to feed their stock. And there's millions of chickens that are you know, could actually be euthanized or because they can't feed them as quickly as they need to. So I know cattle prices are still fairly decent. I think we sold about 17 calves this week and got a pretty decent price out of them. But certain parts of the country are hit worse than others when it comes to drought, etc. So we got another question here. Why do you think the downstream oil and gas companies are a good investment now? Aren't the upstream companies the ones making? So that's a good point, Keith. They are, but energy in general has been really pretty decent. You know, we're in the XLE, which is the energy fund, and it's been hanging in extremely well this past year. Even though we did take some profits, we got back into it when we recently rebalanced. But year to date, the XLE is up, you know, about 2.9%, and it finished the last 12 months about 42%. So these are service companies and other companies as far as pipeline and you know, oil and gas companies that are storage as well. So the dividends on those are extremely well. We're into some that, such as Kinder Morgan and Enterprise Transfer, that are paying, you know, well over 6% and very steady in price. So right now, those high dividends are really helpful, you know, during this time in the market. Okay, any other questions? These are good questions, by the way. Appreciate them. Okay, we appreciate you showing up today, and let me just run back to the last couple of slides. You know, if you have concerns about what's going on, feel free to reach out to me or you know, email or phone call. You know, we can take a look at you know, everything that's going on, and if you've got any other questions, feel free to email or pick up the phone and give me a call. Look forward to talking. So thank you for attending. Appreciate every one of you, and we'll look forward to talking next time. Thank you very much.